Hi friends, good day. Today I'm taking out the second method, maximum possible loss method. Under this method, we assume that every realization is a final realization. I've already told you that we are having two methods for distribution of amount to partners in piecemeal distribution. Either we can follow highest relative capital method or we can follow maximum possible loss method. Under this method, we assume that each realization is a final realization. What do you mean by this, sir? As if there is no tomorrow. It is end of the world. That's it. There is no tomorrow. That is the assumption they follow. Under this method, maximum possible loss. It's clear. The term maximum possible loss. What do you mean by that? Because if today I have realized 5,000, this is final payment. That's it. When you're making payment to the partners, they assume that this is a final amount available. So therefore, they assume that, and there is no tomorrow, the remaining assets are not going to fetch any amount. This is an assumption. That's it. It's not that is not going to happen, but this is an assumption that generally that is being followed under this method. Okay, so and the second thing is this method is generally followed when a partner has become insolvent or likely to be so. Whereas I told you the previous method, highest relative capital method, when partners are solvent or likely to be so, then we can go for highest relative capital. Generally, this method is being followed when partner is insolvent or likely to be so. This method is being followed. So now here, each installment realized is considered to be the final payment. That is, outstanding assets and claims are considered worthless, and partners' accounts are adjusted on the basis of each time when distribution is made. Okay, so this is the method generally we will be following, is called as following either Garner versus Murray rule or the profit sharing ratio rule. See, Garner versus Murray rule is nothing but you have learned that mm, generally we work out the problems are based on Garner versus Murray rule only, unless specifically mentions that the when you assume that it is a final realization, one of the partner at that particular point of time, his capital account may show negative balance. Then we assume such a partner whose account is showing negative balance, we assume as an insolvent person. We assume as an insolvent person. So then such a insolvent person at that particular point of time, uh, suppose I'll give a small example to explain. Let me take you to example so that you'll be having clarity. Let me take an example where there are three partners. Let me explain with this example. A, B, C. Their capital balances, say 10,000 rupees, 5,000 rupees, and 2,000. Under this method, what you do, let me say their profit sharing ratio is 2 is to 1 is to 1. Okay, profit sharing ratio is 2 is to 1 is to 1. Now, what I am doing, 10 plus 5, 15 plus 2, 17. I am writing here total capital, a total amount is coming to 17,000. Okay, 10 plus 5 plus 2, 17,000. Then let me take, say, first realization, say 5,000. Okay, first realization is fine, 5,000. So this 12,000, this 12,000 we are treating as a maximum possible loss. Why I'm using the term maximum? Because this realization we are expecting 4 realization. Say for example, this is a realization. When you are doing this method, you assume this is a first realization is the final realization. That means whenever you realize at that particular point of time, every time you assume it is a final realization, as if there is no tomorrow. As if there is no tomorrow. So then it becomes maximum loss, maximum possible loss. I'll be using the term maximum possible loss. Possible means if there is no tomorrow, this is what the loss, maximum possible loss. So please try to understand total amount minus first realization. It's a maximum possible loss. Now this loss will be transferred to A, B, C in their profit sharing ratio, which is 2:1:1. So please remember, you write capital balances or it can be adjusted capital balances. You know what is adjusted capital balances? Whatever you have learned in case of highest relative capital method, the same is the case. Adjusted capital balances means opening capital plus undistributed profit minus undistributed losses, if any, minus accumulated drawings minus current account adjustments plus or minus current account adjustment, and any advances given to partners by the firm, and if you adjust that, that will become adjusted capital balance. We have seen in the one of the previous problem, if there is no adjustment, it will be called as capital balance. So total amount is 17,000. This is the amount due to partners after making payment outsiders. Please you should remember that whatever the methods we are discussing, be it highest relative capital or be it maximum possible loss method, the important point you should remember is that in both the cases, it is about making payment to partners. It is making payment to partners. So under this method, you need a lot of practice for this. It looks very simple, but you need to practice. Total amount is 17,000. Before you start getting the money amount realized after adjusting the amount due to outsiders, that outside liabilities. So I am taking example 5,000. Maximum possible loss is how much? 12,000. Clear to all of you? Maximum possible loss 12,000. Why maximum term I am using? Because we assume this realization is final realization, as if there is no tomorrow. There is no tomorrow. This is what the loss. It is not reality, we know, but this is the way we approach to the problem. So maximum possible loss. So 12,000 you are getting. Now this 12,000 you will be distributing according to profit sharing ratio to all partners. So 12,000 by 4. 3,000. No, 3,000 to 6,000. And 3,000. 3,000. Now, after adjusting this, what happened? 10,000 minus maximum possible loss 4,000 you are getting. Here you are getting 2,000. And you are getting negative 1,000. Now, remember, this is what he is talking about. Following there, either Garner versus Murray rule. What is Garner versus Murray rule, sir? This is at this particular point of time, we assume this particular partner is insolvent because he is getting negative balance. Whenever any partner is getting negative balance, we assume that particular partner as an insolvent. In fact, he is not an insolvent. We assume that that particular partner is an insolvent. So this amount, 1,000 rupees, will be distributed to A and B by applying Garner versus Murray rule in their capital ratio. In their capital ratio. So that is what I am writing here. So maximum possible loss. That maximum possible loss is complete now. Here I am assuming the deficiency at this particular point of time of C transferred to A and B in their capital ratio. What is capital ratio? 5 ones are 5 twos are. It happens to be here in this problem, it happens to be that capital ratio, profit sharing ratio of A and B is same. But in some cases, the profit, maybe it is 3:1 and this may be different. So you can't say always it is right or always it is wrong. We can't say. That is why at this particular point of time, capital ratio and profit sharing ratio is one and the same. Like you are learned in partnership resolution, when one partner has become insolvent, applying Garner versus Murray rule. So deficiency of C transferred to A and B in the ratio of 2:1. That is 1,000 by 3 into 2. You are getting 667. Then 333. So finally, this amount has been nullified. So this 1,000 has been adjusted, no? 1,000 has been adjusted. Negative 1,000 has been transferred. So 4,000 minus 667. 3,337. 1,667. Now this is what, after adjusting the deficiency of C to remaining partners in their capital ratio, applying which principle? Garn versus Murray. If the problem says that the deficiency shall be adjusted in profit sharing ratio, then no need to apply in which ratio? Capital ratio. You can transfer the deficiency in profit sharing ratio. So then this will become amount paid to partners. Now if you want, you can cross check here. You can cross check here. 3,337 plus 1,667 is equal to 5,000. No? That's it. The 5,000 rupees has been given to A and B. So under this method, I repeat once again, for doing this method, I'll be giving the note also on this. First, you assume that first you should assume which method you are following. In the problem, if it says maximum possible loss method, you follow. And under this method, we assume a partner whose capital account is showing negative balance after transferring maximum possible loss. So what is maximum possible loss? Total amount due to partners minus first realization is maximum possible loss. Total amount due minus first relation is maximum possible loss. This maximum possible loss you are transferring to ABC according to their profit sharing ratio. Clear to all of you? So this is what we have done. 12,000 we have transferred. After transferring one of the partner whose capital account has become negative, then you may be having the doubt, sir, if negative, no problem. If it is not negative, then whatever the balance amount you are having is equivalent to the amount that is being realized. If there is no negative, because if there is no negative, what happened? Maybe like this the total of three, all the three partners amount will become 5,000. But you can see 4 plus 2, 6 minus 1, 5,000 actually. So you got the amount is 5,000 only. You can't distribute more than 5,000. So under this particular method, we assume that a negative partner, the partner's capital is showing negative balance, that will be transferred to the remaining partners. We assume that they are solvent partners in their capital ratio. Generally, if problem is silent, we are following Garner-Murray. Then if you adjust that, it will become amount paid to partners. Now this will continue. So this will continue. Then what I'll write here again, amount due. 3,337 is the amount paid, no? So amount due, how to find out, sir? Actually, you can see 10,000, no? 10,000 minus 3,337 has been paid. So 6,667 is still due as far as A is concerned. B is concerned 5,000. 5,000 minus 1,667. So 3,333. And C in fact, what is the amount due? 2,000, but you are not paid. So don't have any confusion, sir. C has become insolvent. No. At this particular point in time, we have assumed him as insolvent, but in fact, he is not insolvent. Unless he has been adjudicated as an insolvent by the court, you can't take a trade. Under this method, the partner whose capital account is showing negative balance after transferring maximum possible loss, and that amount has to be transferred to remaining partners, assuming they are solvent partners by applying Garner versus Murray rule. Then what happens here? This will become 2,000 only. Now, come on. If you add these things, 6,667 plus 3,333 plus 2,000, it becomes 12,000. Is nothing but previous maximum possible loss. Maximum possible loss 17,000. You have paid 5,000. The same. It's a hint. You can say. Now the total amount due will become 12,000. Okay. Now let us assume second realization as 8,000. Say for example 8,000. Now what is maximum loss? 4,000. This 4,000 transferred to all partners in their profit sharing ratio. Now it is very simple. 2,000, 1,000, 1,000. Now you can see here nobody is having negative amount. All are having positive. 4,667, 2,333, 1,000. Now, as I told you, since there's no negative, now if you want, you can cross check. This is nothing but amount paid to partners. If you want, you can add this 4,667 plus 2,333 plus 1,000 is equal to amount paid to partners is equal to 8,000. No. So only when one partner is becoming negative, then that negative shall be transferred to remaining partners in their profit sharing, in their capital ratio applying which principle, Garner's-Murray, or if problem says it should be transferred according to their profit sharing ratio, that can be done. So this is how this will continue. Then again you write amount due. Now amount due, what happens here? Previous due is how much? 6,667. 6,667 minus 4,667, 2,000. 3,333 minus 2,000, 1,000. Now 2,000 minus 1,000, this 1,000 paid, 1,000. Then will become total amount due. So this step will continue like this. Then again amount realized like that. So I think this particular method is all about assuming that after transferring maximum, why maximum possible loss term we are using? Because we assume every realization as a final realization. Okay. So let me now, I'll read out. If you want, you can copy down this the treatment, the steps to be followed. Or else I'll write, you can copy down also. Maximum possible loss. I'm also explaining you also. If you want, you can copy down simultaneously. This method is suitable when partner is known to be insolvent or likely to be so. So point number 1, procedure, how to follow it. Total the adjusted capital balances. Total adjusted capital balances. From this, deduct the amount available for distribution. And the balance is treated as maximum possible loss. Total adjusted capital balance. From this, deduct the amount available for distribution to partners. The balance is treated as maximum possible. That is what I have done. Total adjusted capital balance. Deduct the amount available for partners. Balance is treated as maximum possible loss. The same point I've explained like a note. Okay, this is point number 1. Point number 2. Distribute the maximum possible loss to partners distribute the maximum possible loss to partners in their profit sharing ratio and deduct after deducting if all partners are having positive balances this positive balance is nothing but amount distributed to partners. Amount distributed to partners. Next, same continuation. However, if any partner has a negative balance, after deducting the maximum possible loss, if any partner has a negative balance after deducting the maximum balance, and that deficiency of such a partner is adjusted to is adjusted to other partners capital account by applying Garner-Murray case. And then available amount is distributed to partners. Okay, then after that I'll explain all the points at a time. Third point, calculate the unpaid capital and repeat the same procedure for each realization. Finally, last point. Final unpaid amount is transferred to final unpaid amount is treated rather. Final unpaid amount is treated as relation loss. Or if amount paid is more than due, it is a relation profit. Now you can see whatever I've explained you. Total adjusted capital balance from this deduct amount available for distribution to partners and the balance is treated as maximum possible loss. Here I have taken the example total amount due, then first relation to maximum loss. This loss is transferred to partners capital account. Point number 2. Point number 1, total adjusted capital and from this deduct the amount available for distribution to partners and the balance is treated as maximum possible loss. This we already discussed. Distribute the maximum possible loss to partners in their profit sharing ratio and deduct. Yeah, this is what I have done. Maximum possible loss has been deducted in their profit sharing ratio, which is 2:1:1. Okay. After deducting, if all the partners having positive balances, then the positive balance is nothing but amount distributed. That we don't have that in the first situation, but we are having that in second situation. Second situation, after deducting that amount, all partners capital accounts are showing positive balances. Clear to all of you? After second relation, maximum possible loss, after adjusting maximum possible loss, all partners capital accounts are showing credit balance. It means amount distributed to partner, the same thing I have given. distribute the maximum possible loss to partners in their profit sharing ratio, and deduct. After deducting, if all the partners are having positive balances, then the positive balance is nothing but amount distributed to partner. This is what happened in second relation. First relation it is not sufficient. Second relation it is sufficient. Okay. This is what, after deducting the maximum possible loss, since A, B, C are having positive balances, which is nothing but amount paid to partners, and that can be amount paid to partners. Clear to all of you? Because they are having positive balance. If it's not a positive balance, then okay. Then that is what I have explained you. If it is not positive balance, what happens here? However, if any part has a negative balance, after deducting the maximum possible loss, that deficiency of such a partner is adjusted to other partners' capital by applying Garner-Saussure Murray case, and then available amount is distributed to partners. Calculate the unpaid capital, repeat the same procedure for each relation. Final unpaid amount is treated as relation loss, or if amount paid is more than due, it is treated as relation profit. This is what I have done here. You can see. First case positive, so amount paid. Second case, second case in the notes I have given here. Since you are getting negative balance, one of the partners is having negative balance, deficiency or transfer to A and B according to capital ratio. Then finally, this is amount paid to partners. Clear to all of you? So I think this is all about your which method? Maximum possible loss method. So we start. In the meanwhile, just I'm giving 2 minutes time. If you want quickly cross check, you can copy down. It's a very simple. Yes, today we had some writing issues. See, I'll repeat once again. If anybody is having the doubt, point number one: after making payment to all outside liabilities, you take under this method only draw the lines for partners capital, then you write adjusted capital balance. Say in this case I have taken example 10,000, 5,000, 2,000, then go for total amount, it is coming to 17,000. From that assume that there is a first realization of 5,000, that is after making payment to outsiders. Then this for every realization you assume it is a final realization. So there is a maximum possible loss of how much? 12,000. Now this 12,000 I am distributing to all partners according to their profit sharing ratio, that is been given as a 2:1:1. So this is what? 4,000, 2,000, 1,000 you are getting negative. Now this negative amount is been transferred to solvent partner. I mean we assume other partners solvent by applying Gano versus Murray in their capital ratio. Capital ratio is nothing but capital balances. 5,000, 10,000 is to 5,000, nothing but 2:1. This is capital ratio. 2:1 is capital ratio. Of course, in this problem, coincidence of A and B is that the capital ratio, profit sharing ratio appears to be same. So you transfer 667, 333. Then what happened? You are getting amount paid to partners 3,337 and 1,667. Clear to all of you? Amount paid to partners. Then after that, whatever the amount paid to partner you are getting, then you take amount due. What is amount due actually? Amount due means total amount due 10,000 minus amount paid 3,337. Still amount due. Similarly, B 5,000 minus 1667, you are getting 3,333. C, this will continue, but at this stage we have assumed as an insolvent, but is not actually insolvent. So 2,000 you haven't paid anything, 2,000. So if you add 6,667 plus 3,333 plus 2,000 is nothing but maximum possible loss of previous case. That's it. That maximum possible loss is nothing but amount you could not able to pay. So 12,000. Again, second realization. Let us assume this is a final realization. Okay, for you to have a clarity. So 8,000. So maximum possible loss is how much? 4,000. 4,000. So this 4,000 you are transferred to partners according to their profit sharing ratio 2,000, 1,000, 1,000. Now 6,667. Since no partner is having negative, I told you your notes also have given. Distribute the maximum possible loss to partners in their profit sharing ratio and deduct. After deducting, if all partners are having positive balances, then positive balance is nothing but amount distributed to partners. In this case, second relation, you are having positive balance. No, this is nothing but amount paid to partners. Okay. Then amount due, total amount due is nothing but 4,000. How you are getting, sir? 6,667 minus paid is 4,667, 2,000. Similarly, here 3,333 minus amount paid is 2,333, you are getting 1,000. 2,000 minus 1,000, 1,000. Okay. Then what he has said, however, if any partner has a negative balance, this is what we have seen in the beginning. After deducting the maximum possible loss, the deficiency of such a partner is adjusted to other partners' capital by applying Garner versus Murray, and then available amount is distributed to partners. This is what I have done. This is in the case here. Since first realization, we got that particular problem. One of the partners become negative. This has been transferred to remaining partners in their profit sharing ratio. So my dear friends, no need to confuse. This is about making payment to partners. Since piecemeal distribution I have been telling right from the beginning, how to make payment to partners is a big issue. To whom we shall make first payment. This is what the method that is being followed, suggested by the accountants. That is what is being followed. There should be some way, there should be some mechanism to make a payment. So no need to worry about it. If you practice, keep on practicing, it looks. But these problems need a lot of practice. That's it. Because if you open after a long gap of time, you'll tend to confuse because there's no debit, no credit involved in this. So I think this needs a bit of practice. It's simple actually. So this is how I've explained to you. Then let me tell you, if I assume this is a finally, what you can say, this is final realization. This is unpaid amount, no? This is finally unpaid. If I assume second relation is the final relation, finally unpaid amount is treated as realization loss. To cover whatever I've explained notes. So last point you can see. Calculate the unpaid capital. Repeat the same process for each relation. Finally, here I have written finally. Finally, unpaid amount. Unpaid amount is treated as realization loss, or if amount paid is more than due, it is treated as realization profit. Okay, now you can see in this case loss or profit, because 6,667 previous due, paid is 4,667. There is no further realization, so therefore it's a unpaid amount is loss. Excess payment means if you are getting negative value, then it is excess. Suppose here you are having say 7,667 you are having, then 1,000 you will be getting. This is what is called as excess paid. But here after first realization 6,667 is due, but how much has been paid? 4,667 has been paid. How much has not been paid? 2,000. 2,000, 1,000, 1,000. And whenever you are doing this, you should cross check this. 2 plus 1 plus 1 is 4,000. No, 4,000 in the ratio of profit sharing ratio. 2:1 is to 1. 4,000 2 by 4, 2,000, 4,000 to 1 by 4, 1,000, 4,000 to 1 by 4, 1,000. So always realization loss or profit is according to their profit sharing ratio. Now let me take out this problem. Exercise 7. We have done exercise 8 in the last class. This has been completed. Okay. Now this we will be completing. Creditors 2,000, A's loan 5,000, A's capital, B's capital, C's capital, sundry assets, cash. The assets realize the following sum in installments. First installment 1,000, second 3,000, third installment 3,900, fourth installment 6,000, fifth installment 20,100. The expenses of realization were expected to be 500, but ultimately amounted to 400 rupees only. Show how at each stage the cash received should be distributed between partners. They share profits in the ratio of 2:2:1. See what they are saying. Before distributing the proceeds, they want to maintain a provision of 500 rupees for realization expenses, but ultimately amount to 400 rupees only means they will be able to know after final realization. Okay, so they kept 500 rupees, but at the end of the completion of the process, they were able to incur only 400 rupees. They need only 400, they were paid 400 rupees. So provision is being kept as 500, 400. This 100 rupees excess, whatever you are having, is you can assume that automatically this 20,100, whatever you are having, we assume that 100 rupees is included in this. Clear to all of you? This 20,100 rupees actually assuming excess provision assuming excess provision for expenses of realization is included in 20,100. Sir, how you are having, sir, this one? See, they have kept 500 rupees for meeting realization expenses, no? But they have incurred only 400. 500 minus 400, that is 100 rupees is included. Clear to all of you? 500 rupees they kept aside, my dear friends, for meeting realization expenses. After completion of realization process, they were able to incur only 400. 100 rupees balance. This 100 rupees is included in fifth realization. If we assume that this 100 rupees is not included, then 20,100 plus 100 rupees you should add. That's it. If you assume that 20,100 is including this 100 rupees, because he has given realization, now we assume that this 100 rupees is included in 20,100. Otherwise, if you assume that is not 100 rupees not included, you'll be adding one more 100 rupees, then it will become 20,200. Okay, the expenses is complete. Show how the each stage that cash received is should be distributed between partners. They share profits in the ratio of 2:1. Whenever you are doing maximum possible loss method, you need to have capital ratio of the partners. Capital ratio, how you will be knowing, sir? Whenever you are having a negative balance, then only you will be able to know. So this problem also can be done like two ways. Having including the amount due to outsiders also, or you can continue like normal way first, whatever you have done for ISTL cap, the same procedure can be followed, or we can have separate statement for making outside liabilities, then we can have a separate statement for capital balance. So since we have been doing like all together at a time, so what I do, let me start doing this problem. And in fact, he has not mentioned which method to be followed, but the heading has been given a maximum loss method, so that is why we are going for maximum loss method only we are doing. Clear to all of you? Maximum loss method only we are following. But if it is silent, it's your wish. You can, same problem you can also, if you want, you can try under which method, highest relative capital method also you can try. So whatever the problems we are working out, you can do. The problem is silent, you can do highest relative capital method or maximum possible loss method. So this problem, since I have to explain maximum possible loss method, and I'm working out maximum possible loss method. Okay, so let me start here. So for this problem, my emphasis is on explaining the maximum possible loss method. What I am doing, first I am making small two statements. You can do, as I told you last class, we can separate outside liability statement separately, statement amount paid to partners. So here I am writing point number 1. Statement showing amount paid to or let me write cash paid to outside liabilities. So here we are having two only, Creditors and ACE loan, that's it. Or we also can do like this, statement showing, let me make it a different way. Just a minute, I'll alter it so that you'll be having clarity. Statement showing realization and distribution of cash payments. First column particulars, second column realization, third column creditors. I think this will be easy to you. Third column partners loan, last column partners capital. Now I am writing here point number 1. Amount available from cash and first realization. After adjusting for, after providing for, realization expenses. Okay, I told you already. Cash is 500. You set aside 500 rupees for what? Provision for expenses. So this cash has been used for 500 rupees provision. Then finally at the end of the relation 400 only they have incurred. That 100 rupees is included in this already. So come on, this 500 has been adjusted. Now what is the amount that is available for making payment relation? 1000. This 1000 has been paid to whom? Creditors. Because what is the amount due to creditors actually? 2000. So how much you have paid? 1000. This 1000 rupees you have paid to creditors. Clear to all of you? If you want, you can also write the amount due also. Just a minute. Amount due, creditors 2000, partners loan, ACE loan 5000, and total partners capital 15 plus 8 plus 9. 15,000 plus 18,000 plus 9,000. It is coming to 42,000. This is what. So first this realization has been used for making payment towards creditors. Okay, this 1000 is completed. The next, second realization amount. Second realization. What is the amount realized? 3000. This 3000, I need only 1000 for this. Now 3000 minus 1000, 2000 I'm using for 2000. 2000 for ACE loan. So nothing has been paid to partners. Third realization. What is amount realized? It is 3900. 3900. Now already creditors has been cleared, and 5000 minus 2000, how much I need? Only 3000. So what is surplus amount I am having that I can use for making payment to whom? Partners. So from third realization onwards I can make payment to partners. Then fourth realization. Fourth realization 6000. This entire 6000 goes to partners. Fifth point. Fifth realization. Including savings in realization expenses. It is coming to 20,100 is including 100 rupees. Savings and relation expense is nothing but 500 minus 400. No, that 100 rupees is also included. Okay. This is what is included. If it is not included, it will become 20,100 plus 100. Now 20,200. Now if you want, if you do like this, the advantage you people have been having is that you should be able to find out the relation loss also. So if you want, you can cross check 1000 plus 3000, 3900 total amount is not required, but I am writing the total also. 1000 plus 3000 plus 3900 plus 6000, 13,900 plus 20,100, 34,000 is the total. 34,000. And Creditas, how much you have paid? 2,000. And AS loan, how much you have paid? 5,000. 34,000 minus 2,000 minus 5,000. This 20,100. No, sorry. No. It is coming to 27,000. This is the amount available to partners. You can see. Amount paid to partners. 900 plus 6,000. 900 plus 6,000 plus 20,100. 27,000. This is amount paid. Amount paid. 30,000, 34,000 realized. This is amount paid. Okay. 34,000 has been paid like this. Now, unpaid. Nil. Nil. Here it comes to unpaid is nothing but 42,000 minus 27,000. It is to be 15,000. This is going to be your final realization loss. I think this you should get after completion of the problem. The statement you can improvise, my dear friends. It's always your choice. Okay, we are doing in a different manner. It's your wish. Every problem, it's not that I will be going the way, but you need to have a clarity. First, I need to make a payment to outsiders, and then I can start doing the problem, because this maximum possible loss method also you can have. If you want, you can compare without writing this one. Directly you can write like a Creditas, AS loan. I'll tell you how you can do, sir. Here you can write Creditas, particulars, like the way we have done for highest relative capital. Creditas you can write, and that also I'll show. Let me write this here. Alternatively, what we can do, we can have here statement showing distribution of amount. To partners under better distribution of cash, you write, under maximum possible loss method. Right term to be used is maximum possible loss. In the notes they have given you maximum loss, but I feel maximum possibility, that's it. When you have possibility, if there is no realization, then as usual, instead of writing separate statement, I am writing this way. Okay, this will become particulars, right? Okay, now what I am writing, amount due. Creditas is I told you 2000, no? Ace loan 5000, then Ace capital 15,000, and what is their profit sharing ratio? 2 is to 2 is to 1. So you also mentioned somewhere 2 is to, here has been given 2 is to 2 is to 1. This is important for maximum possible loss. These three have explained separately, or you can have do the problem including this alternatively, including outside liabilities and cash. Previously I've explained only for distribution of statement showing relation distribution of cash payment, that is in for only for all in a like a summary I haven't. Or if you want to avoid that, alternatively we can start doing this alternatively, whichever is convenient. If suppose if you are continuing this, then this 1 1 2, these two columns are not required, you can straight away start from ABC. Clear to all of you, right? Payment for liabilities can be included here. This is what, of course, whether you do it, you do the statement, still you need to prepare a statement for partners. Clear to all of you, amount due. Now let me start. First realization, amount is, I told you, is 1000 rupees. Here note, cash balance kept as provision for realization expenses. So 1000, this 1000 to whom we are paying? Paid to Kratos. Then next, second realization. What is second realization? 3000. Paid to Kratos 1000. Paid to Ace loan 2000. Then third realization. If you want, you also can go for balancing after every relation. I've told you in the last class. This is balance due after second realization. Then third realization. Third realization is 3,900. 3,900. 3,900, you are paying 3,000 rupees. That's it. Balance for partners. So now what happened? This balance for partners you are writing like this. $900. Then here what happens? This is nil. This is nil. 15,000, 18,000, 9,000. Okay. Suppose if you have continued with this statement, this is not required. Which column is not required? This column is not required. Straight away we could have started writing from where? 15,000, 8,000 from here. 15,000, 18,000, 9,000. Then directly third relation amount available for partners. Like this we can write. Okay, now this is completed. Now what I am writing here, this is important. I am using the red pen to highlight this. Amount due. This amount due can be capital balances or adjusted capital balances, but we don't have adjusted capital balances here. So amount due is this way. Here I should write, sorry. Amount due. $15,000. $18,000, 9,000. Now after that you write total amount, total due. Total due means you should write 15,000 plus 18,000 plus 9,000. It is coming to 42,000. Total due 42,000. Then here I am writing amount from third realization available for partners. Available for partners is how much? 900. Okay, 42,000 minus 900. It is coming to 41,100. This 41,100, I am treating it as a maximum possible loss. Maximum possible loss. So this 41,000 maximum possible loss transferred to A, B, C according to their profit sharing ratio. What is profit sharing ratio? 2:2:1. So 41,100 by 5. Remaining two columns are not required, so I am not continuing that. C 8,220 to 2, it is coming to 16,440. 16,440. Okay, now 15,000 minus, if you deduct this maximum possible loss, I think A is having negative balance. So minus 1640 minus 16,440. Yeah, correct. 16,440. Is it 15,000 or something? 16,440 minus 15,000. Correct. 1440. Now here 18,000 minus 16,440. It is coming to 1560. You are having positive. 9,000 minus 8,220. 780. So now who is having negative? A. Now this negative amount is to be called as a deficiency. We are assuming as a deficiency. Deficiency of A transferred to B and C in their capital ratio, assuming Garner versus Murray. Unless otherwise stated, you better follow which method? Garner versus Murray. Garner versus Murray says the deficiency should be borne by solvent partners according to their capital ratio. No? What is capital ratio? Now I want capital ratio of B and C. I want capital ratio of B and C. 9 ones are 9 twos are 2:1. That's it. What is capital ratio? That is 2:1. So 1440 into 2 by 3. 960. Sorry, here, not here. This 1440 I am adjusting 960. The balance is 480. Okay, then this has been nullified. Now 1560 minus 960, it is coming to 600. 780 minus 480, 300. So this is what is called as amount paid to partners. You may have a question, sir. If suppose after doing this, one more partner has become insolvent, negative. After detecting this deficiency, one more partner has, then the remaining partner will bear. Suppose, let me say, B has also become negative. Then that is to be borne by whom? C. Are you following? After adjusting deficiency, one more partner balance has become negative. Luckily, in this case, B and C has become positive. Suppose after adjusting, suppose B is having minus 600 or minus, say C is having minus 300. That 300 is to be adjusted to whom? B. That's it. Okay. So I think that is very rarely you come across, but try to remember this. This is amount paid to partners. Then amount paid to partners. So this is equal to 600 plus 300 is nothing but 900. You can cross check. Now we will be writing, this is completed, then we will be writing okay, now here we will be writing balance due. Balance due, how to find out, sir? What is amount, actual amount due to partners? 15,000. No? 15,000 minus amount paid is A. 15,000 minus nil. You haven't paid anything. 18,000 minus 600. C. This is B. C. This is only for you to understand. I am writing 9,000 minus 300. So here it will become 15,000 balance. 18,000 minus 600, 17,000. 400 and 8,700. Now this will become total. This total column I'm continuing. If you want to avoid this statement, these three, as I told you, if you can take these three, these two columns separate, then amount ABC. It's your wish. I've told you already. Whichever way you want to work out, you can work out depending upon your time management. Then this is completed. Now after that, fourth realization. We have seen fourth realization directly is how much? Third or fourth? Fourth, I think 6,000. Now here what I should write before I write total due, total amount due is nothing but previous maximum possible loss. If you want to, you can cross check. 15,000 plus 17,400 plus 8,700. It is coming to 15,000 plus 41,100. You can see this is 41,100. So fourth relation is how much? 6,000. Third relation, amount after making payment, we have 900 rupees we got, no? That has been adjusted to partners, no? Third relation. Fourth relation is 6,000. Now 41,000 minus 6,000, it is coming to 35,100. 35,100. This 35,100 we are treating as a maximum possible loss. In the ratio of 2:2:1. 35,100 by 5, it is coming to 7,020 into 2, 14,040. 14,040. And now I think in this case we are all having positive values. So minus 14,040, 960, 17,400 minus 14,040, 3,360, 8,700 minus 7,020, it is 1680. Now I told you, when you are not having negative, this is nothing but amount paid to partners. Then you can cross check whether it is right or wrong. 960 plus 3,360 plus 1680, it is coming to 6,000. Amount paid to partners. Clear to all of you? Now once amount is paid to partners, then we'll be getting balance due. Balance due is nothing but, what is amount due? Balance due actually before the fourth relation 15,000. After fourth relation 960 paid. So 15,000 minus 960. Then here 17,400 minus 3,360. And here 8,700 minus 680. I hope you all are following this. This is a disbursement. 15,000 is the balance due. Amount paid is 960. 17,400 due paid. 8,700 due paid. Then 15,000 minus 960 coming to 14,040. Okay, 14,040. Then 17,400 minus 3,360. It is coming to 14,040. Next, 8,700 minus 680, 8,020. Not 8020, 8700. Okay, 8700 minus 1680, sorry. 8700 minus 1680, 7020. Now, why I got out, after when you don't have, I'm giving a hint to you, when you don't have any negative balance, the balance amount, available amount due is according to their profit sharing ratio. See, after distributing this amount, if you don't have negative value, after deducting amount paid to partners, balance due is according to their profit sharing ratio. You can cross check 7021 za, 7022 za, 7022 za, which is nothing but our profit sharing ratio of 2:2:1. Clear to all of you? This is an hint I have given you. Next, last point, last realization. Now here I have tried total due. Total due is nothing but which is equivalent to maximum possible loss, 35,100. Even if you want, you can cross check also. This is balance due I have written. Then I am writing total amount due, total due, total amount due. This previous maximum possible loss. If you want, you can cross check also. $35,100. Next, last final realization. Fifth realization, last one. Fifth realization, let us look into it. 20,100 including surplus, I have told you, 20,100. So 35,100 minus 20,100, you are getting 15,000. This also we have cross checked here in the beginning. Somewhere I have written here. Unpaid amount 15. It's got the same thing, no? Yes, we can. Yes, it's like disbursement, my dear friends. This is finally unpaid amount. Is realization loss. That's it. This 15,000 you distribute according to their profit sharing ratio. 15,000 by 5. 3,000 into 2, 6,000. And it is 6,000. It is 3,000. Now you can say here 14,040 minus 6,000. It is coming to 8,040. Here also 8,040. Here 4,020. Because I am confident that it is according to ratio, no? Unpaid amount is, or paid amount is also in ratio. Unpaid amount is also ratio. So 14,040 minus same, no, 6,000. 7,020 minus 3,000. 4,020. This is amount paid to partners. Finally, unpaid amount is realization loss. 6,000. Oh, sir, you also can cross check. 14,040 minus 8,040. Unpaid is 6,000. 14,040 minus 6,000 minus 8,040, 6,000. 7,020 minus 4,020, 3,000. This is according to their profit sharing ratio. And I remember long back one student was asking me, it is a big class of consisting of more than 400 students, and I remember I never expected that. Actually, we never thought of this question on, sir, what is the difference between highest relative capital and maximum possible loss method? I have never really given thought. In no book you got that. I never given thought what is the difference, sir. Finally, after taking one class, because I was leaving, I was having next class. then I got chance to go back and see, and my observation then after that is comparing is that the deficiency, a simple point, if you want the same problem, you can try highest relative capital, then you can see whatever I am saying, why you are getting amount paid to partners under that method, and this method can be same. When deficiency, you are transferring in their profit sharing ratio. That's it. What is the major difference? I repeat once again. The difference about amount paid to partners under highest relative capital maximum possible loss method is that deficiency are distributing in capital ratio. If deficiency are distributing in profit sharing ratio, amount paid to partners will be same under both the methods. Clear to all of you? I repeat once again. Amount paid to partners will be same when deficiency under maximum possible loss method is transferred according to their profit sharing ratio. If you are transferring in their capital ratio, then amount paid to partners will be different for highest relative capital and maximum possible loss method. One more point. Suppose there is no deficiencies are here. No deficiency. Entire problem is having positive value. Then there is no difference between highest relative capital maximum possible loss method. Okay, if at all if you are having any deficiency, and that deficiency, since you are transferring in capital ratio, what we can say, the amount paid to partners will be different amount under highest relative capital method, under maximum possible loss method. If deficiency also you are distributing according to their profit sharing ratio, then both the answers will be the same. Okay, I think this is just explanation, no need to worry about it. I think we don't have many number of problems on this, so but I will sign off today's class by giving you one problem as a homework to you. That problem is that we have done lamb, deer, peacock, lamb, deer, peacock. For that problem, I want you people to we have done first problem on highest relative capital method. This problem you do maximum possible loss. We have already done highest relative capital, and either you do maximum possible loss method. This we have done already highest relative capital. You do either maximum possible loss or highest relative capital method. Finally, unpaid amount answer will be the same. Relation loss will be the same. So you complete this problem as a maximum possible loss method, and I'm reserving around 5 to 6 problems from all the methods. Particularly, you don't have many number of problems on amalgamation of partnership firms, dissolution, conversion and sale, piecemeal. Around 5 problems I wish to take out separately, separate class. Maybe before the examination, after completion of the entire syllabus. I'm planning like that. So it will be good for you to have revision also. So this piece maximum possible loss method, you try this, and you can also try the second problem that we have done. For that also we have done. Okay, this is enough, more than enough. Okay, you do this problem as a lamb, deer, peacock, you do as a maximum possible loss method, and it will be practice. And the next class I will be starting amalgamation of firms. You don't have much to discuss on this, but there are 1 or 2 with typical adjustment that I will be taking out in a revision process. Like partnership, I want to, for every batch I will be doing like that, whether it was in group 1 or group 2. What I will be doing is that these 5 to 6 problems approximately, I will be taking as a revision that will cover. In the meanwhile, we will be thorough with this entire whatever so far we have discussed. So tomorrow, the 4th segment which I will be taking about is amalgamation of firms. With that, we will be having overall clarity on. I've taken more number of hours also to explain, even in online also, like recorded session also. I tried my level best to convey exact what is this particular topic is all about. But if you got any doubts, you can send a message. Definitely I'm going to help you out, right? We'll meet in the next class. Till then, goodbye. Thank you. God bless you all.